Welcome to Wealth Plan TV. I need to remind you that the competition is running for an iPad, generously donated by AIA, and this iPad will be awarded for the best question asked on the website. So please get on the website and ask your question. Not only might you get an answer that will be pleasing, but you might also win an iPad, thanks to AIA Australia. Okay, today we're dealing with accumulation. We spent some time in the first series looking at different asset classes and what their characteristics are and how they might be fitted into a portfolio. But I want to make that a bit more real, but firstly I'll recap those because they're quite important for what follows. Cash is an income investment. A dollar is always a dollar, so there's no risk of loss. But the risk is that you don't have growth. So in a cash investment, whilst you can never lose the dollar, you can lose value. So in the, 50s, you could have bought a house for $500. Instead, if you'd stuck that $500 under your mattress and pulled it out now, you wouldn't even pay the rates on a house. So you can see that cash has a cost, even though there's no risk of loss. And that loss is that inflation will erode it. So cash is very secure, but subject to loss through inflation. Bonds, they're an income investment also. They promise to pay an agreed income for a defined period and then give you your money back. And bonds are secure, assuming the person you lent the money to, the issuer of the bond, will be around to repay you. So therefore, the people who are most likely to make that promise or meet that promise to you is government bonds, and the type of bond that's the least likely to make that promise is junk bonds. So you can see that bonds as an asset class doesn't cover it. It's what type of asset you're holding in that asset class. So because interest rates affect bond values, you can even have a negative return in a bond portfolio where the bonds are traded. So we have had cycles in the Australian market where bonds actually have produced a negative return, even though they're an income investment. Shares. Shares allow you to own a part of any listed company. As I said earlier, you can walk into the CBA bank if you own a CBA share and say, this square meter's mine. You enjoy the benefits that accrue through that ownership if the company does well, and the losses if they don't. Shares are a growth investment, which means that you receive income in the terms of dividends, assuming dividends are paid, growth in relation to the value of your shares, assuming they go up. And over the long term, I think we can assume that if you've selected good shares, you will get dividends and growth. With shorter term purchase decisions and with smaller stocks, one could claim that this isn't actually investing, this is gambling. And like all gambling, sometimes it works, sometimes it doesn't. I personally prefer investing. Property. Property is also a growth investment. You receive rent from your investment property, and again the value moves hopefully upwards. Property is a favoured investment because of the tax system. The tax system favours it quite heavily. But property is very lumpy. You can't sell a chimney or a back door if you want a little bit of cash. It's all or nothing. And transaction costs are expensive. They say that even in a growth cycle for property, you actually have to hold a property for 5 years to defer the purchase and selling expenses. So it's a good asset for the long term, just like any growth asset, just like shares. To benefit from a negatively geared residential investment property, you actually have to have growth in the investment, because negative gearing means you're losing money and the tax office is giving you 30 cents or 50 cents back on the money you've lost. There's no point in losing money unless the property value is moving upwards. So property prices aren't currently moving upwards. It might be a good time to buy, it might not. I guess that this is always a battle, isn't it, in choosing investment types. Commercial property and retail property are accessible to normal investors, generally through investment managers, however. Okay, now let's, having recapped that, let's have a look and see how to determine what our asset allocation is. You need to get information from your fund manager if you don't know, and fill in a table that looks like this. Investment manager, asset type, income or growth investment, value, and a percentage column which we'll come to. So you can see our first investment there is a Colonial Australian share fund. It's growth and it's worth $11,000. We've lobbed in a cash investment. It's an income investment for its 7,000. They're all colonial because we've probably accessed these through a master fund or something. So they're a single investment, single reporting line, but a number of different assets held within that. We've got Australian Bond Fund, we've got an International Bond Fund, International Share Fund, Australian Property Fund, International Property Fund, and the next one's a bit more interesting. We've actually got an investment property. Now that investment property is valued at 340,000. We've got debt of 280,000, so I've added the value being the equity of $60,000 in its value. That gives us a total of $115,000 worth of investments that we're going to analyse for portfolio analysis. Right, now to determine the percentage of each of those asset classes, we just divide the value of the individual asset class by the total value of the portfolio. So in relation to Australian shares, 11,000 divided by 115,000, it gives us 9.5%. We do this for each individual asset. So cash 7,000 represents 6% of the portfolio. Australian Bond Fund 9,000 represents 8% of the portfolio. International Bond Fund 7,000, 6, etc. Again, interestingly, the property represents 42% of the total portfolio. Just add those up to make sure that we've done the figures correctly. If they come to 100, you've got the right answers. Okay, now we can analyse the portfolio in a number of different ways. We can analyse it in terms of income and growth. We can analyse it in terms of Australian and international. We can analyse it in terms of the income assets, cash versus bonds, or the growth assets, property versus shares, or any other way that we think is appropriate. So let's have a look firstly at our income growth. The income growth ratios are important because they tell us whether we're balanced, aggressive, entrepreneurial, secure, conservative. This is generally the number that allocates you as an investor type. So we've got income investments of 23,000. We divide that by 115 and get 20%. So of course the growth assets are 80%. So this means 80-20. That would have you as a assertive investor. So one back from the most aggressive and one up from balanced. But these things are just good for advisors but meaningless for you. My view is you go as risky as you can possibly tolerate, and this is a long-term investment. My view is you can tolerate heaps. But again, it's whatever keeps you comfortable. If you wake up in a sweat, make it safer. Okay, let's have a look at Australian and international. Funnily enough, we've got a 20-80 mix there as well. 23,000 in Australian gives us a 20%, which means the remainder Australian is 80%. Let's have a look again for cash bonds. Now what we're doing here is we're taking 7,000 in cash and dividing that not by the total but by the amount in the income investment, which is 23,000. So in our income portfolio, 30% is cash and 70% is bonds. This is either good or bad. It's not important. The issue is that you begin to understand it. So we now can look at the portfolio in terms of the growth area in shares and property. This figure is telling us a little bit more. We've got $23,000 in shares and a total asset in growth assets of 83,000 because of the property, which means that the shares represent 27% of our portfolio and the property 73%. What we can do now is we can begin to analyse something to tell us about our investment. We can see from this analysis that we're heavily overweight in terms of property. 52% of the total portfolio and 73% of the growth portfolio. This isn't necessarily a problem, but it gives us information from which we can make decisions. This has been a little bit technical, and I can understand that it's difficult, but it's well worth doing because portfolio analysis is a very useful tool. Next time we visit Accumulation in show 11, we'll actually extrapolate this information, see how we can create an ideal portfolio for you and balance back to that ideal portfolio. This is an incredibly good strategy in relation to your portfolios, because what we actually do by using a rebalance is we sell high and buy low. But more about this in episode 11. Thank you for hanging in there. I know it's a little bit technical, but when we build on the next show, you'll see that it was well worthwhile. We'll see you after the break. We'll be talking to Shane about accumulation from an advisor's perspective. See you then.